Section 4, solvency and liquidity. So guys, remember I said this is MB because we're going to have to apply this calculation to certain decisions. So if they want to have us enter into a transaction that requires a big decision on the company's behalf, then they potentially have to apply the solvency and liquidity. So which are those decisions, guys? Here we go. Section 44, offering financial assistance for the purchase of shares. Section 45, giving a loan or financial assistance to a director. Or Section 46, a distribution. So what you can see is when there's an outflow of cash or assistance in some way by the company, they need to apply the solvency and liquidity first before they can decide whether they can provide that financial assistance or distribution. Okay, so what is solvency and liquidity? Guys, you should be quite comfortable with this from your MAC stuff, but solvency, can their assets cover their liabilities? So it is your total assets. Here's something very important. Fairly valued, that should either be equal to or greater than their total liabilities, which are once again fairly valued. So if you have a question and you need to apply the solvency and liquidity and you've got costs of certain assets and then you've got the fair value, you need to use the fair value. Okay, because solvency is dealing with fairly valued. Okay, if you don't have a situation where you've given fair values, you've just got assets and liabilities, then you use that. So where there are financial statements, there's a likely chance that you should be doing solvency and liquidity. And guys, irrespective of what you've seen, as soon as you see financial statements or you see in the question that there's got a statement of financial position with your assets and liabilities, straight away go and quickly calculate solvency and liquidity. Just compare total assets to your total liabilities to see if they are solvent or not, just for your understanding of the financial position of this company. And liquidity is not dealing with your current items. And so liquidity is, can the company pay their debts as they fall due within the next 12 months? So that's why we say it's current. And so therefore we're looking at current assets to current liabilities. Are current assets greater than or equal to current liabilities? And guys, this one is crucial, because if your current liabilities exceed your current assets, then you actually cannot pay or settle the liabilities with what you have, which is really a concern with a business. And so when we look at these two, which of the two indicates that the business is struggling? It's liquidity. And so remember, we've just looked at or touched on the fact that reckless trading is going to be a very important section. Here is an indication of when a company is recklessly trading. Section 22, if a company cannot pay their debts as they fall due, it is reckless trading. And that's bad. I mean, think about it. If you were the company and you were not classified as a reckless trader, nobody wants to buy from you because you do things recklessly, and therefore we don't want to be associated. Okay, and as we get to reckless trading, you'll see it's a little bit more significant than just being labeled a reckless trader. In fact, your business could be closed as a result. Okay, so what we're seeing here is that for certain decisions where we're going to have to provide or outflow of assets, we are going to have to perform the liquidity and solvency test to see if that decision can be lawfully authorized. And in performing the solvency and liquidity, guys, they have to do, or they have to go together. That's why it's called a solvency and liquidity. I have to perform solvency, I have to perform liquidity, and ultimately they should pass solvency and pass liquidity for the decision. If they don't pass either, then they should not be able to make either of those decisions. Okay, and guys, I just want to give you just a little bit of a closer to home example as to why liquidity is the crucial item here. Think about your status. If you have financed a vehicle, when you go and take out that finance and buy that vehicle, you purchase the asset for a rand amount. And that's the value now of the asset. Okay? But in financing this vehicle, you have to take a loan. And the beauty of financing, time value of money principle, means that that current loan or current value of the loan is actually greater than the asset because of the interest time value of money. So if I look at that, and I was just to look at it from a total perspective, asset to liability, my liability is going to be greater than the asset. So now I'm in a situation where I'm not solvent because the total liability exceeds the total asset. However, does that mean I cannot exist in the world? No, because I have an income that allows me to pay the monthly installment. My income allows me to pay that monthly installment, which means my income allows me to be liquid. So although when I look at it at a total perspective, total asset to total liability, my liability exceeds my assets. But when I'm looking at it from a liquidity perspective myself on a daily basis, as the months go, I can settle that loan monthly, because the monthly installment isn't that full amount. That full amount is what I owe over 6 years. But on a monthly basis, I have enough liquid capital to be able to settle each month installment, which means I'm actually liquid and I can continue. And so that's why we say, looking at a company, they're going to have lots of assets where the liability, because of time value of money, exceeds the value of an asset. Look at your mortgage bonds. So they're going to have a property. The asset is going to be valued less than the liability at inception because of the liability time value of money. But can I pay the monthly bond installments? Yes, because I have enough cash flow on a monthly basis to settle that. And so I am liquid, although I may not be solvent. But I can exist. The company can carry on running in this situation. And so therefore solvency is not a problem when it comes to whether this business is able to function in the long run. Liquidity is, because if they can't make those bond installments, they can't pay that vehicle finance, then they're going to eventually have the bank or whoever has financed that vehicle take that asset back because they aren't able to settle it. And that's when the business starts to run into big financial problems. And so that's why reckless trading is linked to liquidity only, not to solvency. One last thing that I do want to add is that when we are looking at solvency, probable contingent assets and contingent liabilities need to be included in that solvency calculation. Only probable ones. Okay, let's go have a quick look at the Companies Act Section 4. Section 4, Solvency and Liquidity, got two things. A says the assets of the company, fairly valued, must be equal to or exceed the liabilities. And B, they must be able to pay their debts as they fall due within the 12 months. If we take a look down here, it also says please include reasonably foreseeable contingent assets and liabilities.